Are you looking for ways to passively generate an income stream? Do you want to earn money while you sleep? Then dividends might be for you. In this video, we will explain what dividends are and how you can potentially profit from them. Hang on until the end to discover how much you could make with dividends. In 1998, Warren Buffett said the following about dividends in a Berkshire Hathaway annual shareholders meeting: "I prefer buying businesses rather than buying stocks. I prefer businesses that have a high return on capital employed, which use a lot of equity capital and little debt capital. I prefer businesses that, when they don't have an idea as to how to use their money to advantage, they give it back to me by either paying dividends or repurchasing shares. When you invest in a company's stock, you become a partial owner of that company. As a shareholder, you may be entitled to receive a portion of the company's profits, which are distributed as dividends. Dividends are typically paid out in cash, although some companies may also offer dividends in the form of additional shares of stock or other assets. The payment of dividends is usually determined by the company's board of directors, who consider factors such as the company's financial performance, profitability, and future investment needs. Dividends are a way for companies to share their profits with their shareholders, allowing investors to benefit from their ownership in the company beyond just the potential increase in stock price. They are often considered a sign of financial strength and stability, as companies that consistently pay dividends demonstrate their ability to generate consistent profits. It's important to note that not all companies pay dividends. Some companies, particularly younger or high-growth companies, may choose to reinvest their profits back into the business instead of distributing them to shareholders. In such cases, investors may still benefit from potential capital appreciation if the stock price increases over time. When you receive dividends as a shareholder, you can choose to reinvest them by purchasing more shares of the company's stock, or you can take the dividends as cash and use them as you wish. The decision on how to use the dividends depends on your investment goals and financial situation. It's also worth mentioning that dividends are typically subject to taxation. The tax treatment of dividends varies depending on the country and your individual circumstances, so it's advisable to consult with a tax professional or financial advisor for specific guidance related to your situation. Overall, dividends are a way for companies to distribute a portion of their profits to their shareholders, providing an additional potential benefit to owning stocks beyond the potential for capital appreciation. When considering dividend-yielding stocks, it's important to conduct thorough research and consider various factors that contribute to a company's ability to pay dividends consistently. Here are some key points to look for when picking dividend-yielding stocks. Dividend yield. The dividend yield represents the annual dividend payment relative to the stock price. It is calculated by dividing the annual dividend per share by the stock price. A higher dividend yield indicates a higher potential income from your investment. However, it's important to consider the overall financial health of the company to ensure the dividend yield is sustainable. A very high dividend yield could suggest that the stock price has declined significantly, potentially indicating financial challenges for the company. Dividend history and growth. Assess the company's track record of paying dividends. Look for consistent dividend payments or a history of dividend increases over time. A company that has a consistent or growing dividend history demonstrates its commitment to rewarding shareholders and its ability to generate stable cash flow. Check if the company has maintained or raised its dividends even during economic downturns, as this can indicate resilience and financial strength. Payout ratio. Evaluate the proportion of a company's earnings that are paid out as dividends. The payout ratio indicates the sustainability of the dividend payments. A lower payout ratio suggests that the company retains more earnings for reinvestment in its operations or future growth. This can be favorable as it indicates that the company has a buffer to maintain or increase dividends even during challenging periods. Conversely, a high payout ratio may indicate that the company is distributing a significant portion of its earnings, which could limit its ability to reinvest in the business or respond to unforeseen circumstances. Financial health and stability. Consider the company's financial health, including its profitability, cash flow, and debt levels. A financially stable company is more likely to sustain its dividend payments even during economic downturns or challenging market conditions. Look for companies with solid balance sheets, consistent profitability, and strong cash flow generation. Analyze key financial metrics such as revenue growth, net income, and free cash flow to assess the company's ability to generate the necessary funds for dividend payments. Industry and competitive position. Assess the industry the company operates in and its competitive position within that industry. A company operating in a stable or growing industry with a competitive advantage may have a better chance of maintaining its dividend payments. Look for companies with strong market positions, durable competitive advantages, and a solid business model that supports consistent cash flow generation. Consider the company's ability to adapt to industry trends and potential disruptions to ensure long-term sustainability. Dividend policy. Understand the company's dividend policy, as outlined in its financial statements or investor communications. Some companies have a formal dividend policy, specifying the percentage of earnings they intend to distribute as dividends. Others may have a more flexible approach, where dividends are determined based on financial performance and capital allocation priorities. Review the company's dividend policy to gain insights into its intentions regarding future dividends and its commitment to shareholder returns. Overall investment objectives. Consider your own investment objectives and risk tolerance. Dividend stocks are often favored by income-oriented investors seeking regular cash flow. However, it's important to assess how dividend stocks fit within your broader investment portfolio and align with your investment goals. Determine the role of dividend stocks in your portfolio and understand the trade-offs between income generation and potential capital appreciation. Balance your investment strategy with diversification across asset classes and consider other factors such as risk management and long-term growth prospects. By carefully evaluating these factors, you can make more informed decisions and potentially find dividend-yielding stocks that align with your investment goals and risk tolerance. Remember to conduct thorough research, review financial statements and reports, and stay updated on the company's performance and market conditions. Coca-Cola Company is a well-known beverage company with a long history of paying dividends. Over the years, Coca-Cola has established itself as a reliable dividend stock, making it appealing to income-oriented investors. The company has consistently paid dividends and has a track record of increasing them over time. For example, let's consider Coca-Cola's dividend history. In recent years, the company has typically paid quarterly dividends. In 2011, Coca-Cola paid an annual dividend of $1.88 per share, which gradually increased to $1.68 per quarter by 2021. Similarly, Johnson & Johnson, J&J, a global healthcare company, is renowned for its commitment to dividends. With a strong track record of dividend payments, Johnson & Johnson is often favored by income-seeking investors. The company has a reputation for stability and consistent dividend growth. Looking at Johnson & Johnson's dividend history, the company has demonstrated a long-standing commitment to its shareholders. If we look at the same time period as Coca-Cola, the company had an annual dividend payment of $2.28 per share in 2011, which had grown to $4.04 per share by 2021. If you had invested $10,000 in Coca-Cola back in 2011, you would have earned $470 in the first year without taking any increases in stock price into account. If you had kept that investment for 10 years, by 2021, you would be making $1,680 per year without lifting a finger. The good thing about dividends is that they are determined by the number of stocks you own, and therefore, the share price doesn't directly influence the amount of dividends you receive. If you had left your money in that stock for the past 10 years, you would have doubled that amount, and that is without having reinvested the dividends but just kept them for yourself. As you can see, you would not be making huge amounts of dividends unless you invest a large sum of money. If you have $1 million and you put it into Coca-Cola in 2023, then you would potentially be making more than $100,000 in dividends each year. In general, dividends are a good way to earn a little extra passively, but I would always recommend that you invest in the company that is right for you and then see the dividends as a bonus rather than your primary goal with the investment. If you found this video interesting and want to learn more about investing, we would recommend that you get one of our investing ebooks, which can be found in the description below. Thank you for watching, and make sure to hit that like and subscribe button.